And we are live and we are back. Let's go. Welcome to, I need to start getting the numbers down, y'all. I think this is the sixth one. The issue is I did two in one day, so my brain's kind of off. But welcome to the Cory and Full Effect podcast, where we discuss health and wealth, finance and fitness, and everything in between. We want to make sure you save more and say less and keep making better your best. I am Cory, one half of the Cory and Full Effect podcast. My co-host Jordan is still on paternity leave, so while he is out, y'all know what it is. On Wednesdays, we do Wealth Wednesdays. But before I get started, make sure you hit that like button for the YouTube algorithm. Make sure you leave your comments. Make sure you subscribe. And on the podcast platforms, make sure you leave your rating reviews. Give me 1 second. My camera's off. There we go. That's a little bit better. I'm in the middle now. Yes, make sure you do everything required for these algorithms. Make sure you be. Make sure you are interactive. Okay. As far as my information, I'm Sideline_Cory. You can find me on Twitter, Instagram, and TikTok. And as I said, my co-host Jordan, his information is Stop Stalling J. He is on Twitter, Instagram, and TikTok as well. And then his business page is FinallyFit.live. All of our information can be found on the show notes in the YouTube description. Okay. As I say for Wealth Wednesdays, we get straight to the point. So as you can see for the video title today, we're going to talk about income versus assets versus liquidity. I don't know how long I've been teasing. I teased stuff for a long time, but I've been teasing this probably for a few months now. As far as moving away from just like, okay, talking about the budget and just managing your money, quote unquote, to actually talking about how you will look to manage your entire portfolio as you go forward into the future and how you need to handle your money as you make more, build more assets, etc. So what we're going to do is I'm going to define each of these three things. That's going to be four things. We're going to talk about liabilities as well, because it's the opposite of assets. You can't really talk about assets without talking about liabilities, but it didn't sound as cool. Income versus assets versus liabilities versus liquidity. That was too many words. So I took out liabilities here, but you don't want to have any liabilities, which is why I left it out. So first things first is we're going to define income. And this is coming from Investopedia, where you can get an answer to almost every single financial question. But for Investopedia, it says the definition of income refers to money that a person or entity receives in exchange for their labor or products. Income may have different definitions depending on the context, for example, taxation, financial accounting, or economic analysis. For most people, income means their total earnings in the form of wages and salaries, the return on their investments, pension distributions, and other receipts. For businesses, income means the revenues from selling services, products, and any interest and dividends received with respect to their cash accounts and reserves related to the business. Economists have different definitions and ways of measuring income, whether their studies involve earnings, savings, consumption, production, public finance, capital investment, or other related topics and subtopics. Their concept of income will correspond to the purpose of their research, while the measure of income on a macro level is critical to societal and policy studies. Individuals are more focused on their personal and business income. So for the sake of this, we're going to talk about your personal income, your W-2 income for you entrepreneurs, how you guys make your money. You might be getting 1099, whatever you do, but just the income that you're making. Okay, this is the easy one. I hope most of you, but most people do have some type of income, how much money you're earning. In short, if you want to look at how much you get paid gross, what you file on your taxes, whatever it is, that's how much money you are making. And a lot of times people will have the conversation and say, what's more important, increasing your income or decreasing your expenses? Right. And I like to think about this. This is real life. Life is not a test. Like, it's not school. There's another option. And I always say managing your money is more important than increasing your income or decreasing your expenses. Most people usually say increase your income because you can only cut your expenses, but so low. And if you want to build, some wealth, really, you need to increase your income. However, even if you lower your expenses and increase your income, if you don't know how to manage that money, right, you can't out earn your stupidity. So, MC Hammer scenario here, but no matter how much money you make, if you do not know how to manage that income, you can lose it all, right? And so managing your income, and this is why I always say you're better off lowering your expenses, because managing your income or managing your finances usually shows itself in the form of you being able to control your expenses, right? So you want to keep your expenses as low as possible, eventually be able to fix your expenses. And that way, any income or increase in income you get, you already know how to manage your money due to the habits that you built from learning how to manage your expenses or lower them. And you're already in position, well, oh, I got a pay raise. Since you've managed your expenses, you don't do the keeping up with the Joneses mindset and just go ahead and, get another car loan, right? Get another mortgage, whatever. You don't increase your expenses. You boost up your savings if need be, but you increase your investing / your lifestyle, whichever two that you need to do in that situation. But you usually invest more money because you know how to manage your money. Okay, so that's my little spat on that. Your income is highly important, but at the end of the day, you need to know how to manage your money. Okay, that's income. Now, the second one is liability. So I can go ahead and get that out the way. Liability. Definition of a liability is something a person or company owes, usually a sum of money. Liabilities are settled over time through the transfer of economic benefits, including money, goods, or services. Recorded on okay, it's talking about balance sheet. Recorded on the right side of the balance sheet, liabilities include loans, accounts payable, mortgages, deferred revenues, bonds, warranties, and accrued expenses. Liabilities can be contrasted with assets, which we'll get into next. Liabilities refer to things that you owe or have borrowed. Assets are things that you own or are owed. Okay? Y'all know what liabilities. Liabilities is debt. It's debt. Okay? Decrease your debt as fast as possible. And I'm not going to get into the liabilities that much because there are plenty of hours of me discussing that. But liabilities, as it says, anything that you owe. Okay, so if you have a debt on something, if you got a debt payment, anything like that, you owe somebody or some company, some bank, some money, that is a liability or a debt. Now, I think I discussed this on any of the mortgage related episodes, but your personal home. Your personal home could be viewed more as a liability than an asset because at the end of the day, you want to look at a liability as something that you don't make money on, in short. And when it comes to your primary residence, you can never truly make money on it because you always need somewhere to live. And so, I mean, you can't do the Airbnb, rent out your own primary residence right nowadays. But for most people, especially if you have a family, like you don't want no strangers in the house with your kids. That's crazy. But for most people, their house is just, they're making the mortgage payment, you're paying the petty principal, interest, tax, and insurance. And that's it. You're doing all the rehab for it, right? All the fixer upper type of stuff. And that's it. You never even make any true money out of it. Even when you do build equity, if you end up selling the home, right, you need usually most of that, if not all of it, to go into a new house. You never actually make use of the equity. And if you do something like a HELOC or a home equity line of credit, that same thing, or a home equity loan, you end up taking out debt. So now it's definitely a liability because you got there's debt attached to it. Okay, most of the time people use a HELOC home equity loan to do something, get a new kitchen, anything like that. Most people aren't using it to go buy another property. Okay, another investment property. But that's a liability. Okay, it's debt. Liabilities are bad. Liabilities need to go away. Okay, next thing we're going to do is assets. And I already touched on it. Assets are the opposite, right, of liabilities. But an asset is a resource with economic value that an individual, corporation, or country owns or controls with the expectation that it will provide a future benefit. I got my mic is covering one of my eyes, so it's hard for me to see. As I can read, y'all. Assets are reported on a company's balance sheet. They're classified as current, fixed, financial, and intangible. They are bought or created to increase a firm's value or benefit. Okay, in the firm, that's more business stuff. An asset can be thought of as something that in the future, can generate cash flow, reduce expenses, or improve sales, regardless of whether it's manufacturing equipment or a patent. Okay, so that can in the future can generate cash flow, reduce expenses, right? It's from personal, so there's not going to be improved sales here, quote unquote. That just goes back to tying into my point about your house. Your house usually doesn't increase your cash flow, especially out here taking out the 30-year mortgage, right? Reduce expenses. Y'all not looking to pay off the mortgage anytime soon. I mean, I guess in the future, by definition, you can consider an asset because hopefully if you pay off the house in 30 years, but if you're out here and you get a mortgage, pay on it for 5 years, then get another 30-year mortgage, that's 35 years. They looking to come out with a 40-year mortgage. It's like, I mean, cool. You plan on reducing your future expense for your mortgage payment in 45 years. Like, I guess you can make it an asset in that case, but you don't generate any cash flow for it. You're the only person living out from it because you're the only person living out of it. And then, like I said, you're not reducing any expenses. And we're not talking about sales here. That's an asset. Essentially anything that is going to make you money. Okay, well, at least you plan on it making you money. The economy is crazy; anything can happen, but it's something that can make you money. All right. Now the next thing, and this is an important one. Well, they're all important. And again, I don't know if I said all of these are from Investopedia, but they all are. Um, Liquidity. Okay, so you got income, assets, and then liquidity. Let me update this. I'm not, these people aren't lying. Running these live shows is crazy. I gotta click over here. Anyways, liquidity refers to the efficiency or ease with which an asset or security can be converted into ready cash without affecting its market price. The most liquid asset of all is cash. Okay. So liquidity means essentially how fast can you turn something, an asset, whatever it is, into cash, because cash is the most liquid thing. All right. So the liquidity is a time, and there's costs, added into it as well. How much you have to pay in penalties or fees to make it liquid, because obviously the less cash you have, the less liquid you quote unquote are. I mean, if all your money is in cash, but all your money is $100, I mean, like, you are 100% liquid, but I mean, you only got $100. So you have to pay attention to that as well. But it's about how fast or with ease, and then that's the efficiency part, the taxes and the penalties. But the efficiency or ease with which an asset, so not a liability, but an asset, can be converted into ready cash. Again, like your primary residence, viewing it as a liability is not very easy to convert that house that you're living in, right, into cash, because you need a house to live in. So even if you sell your house to get all the equity out, right, you're going to need somewhere else to live. So you're going to need some of that liquidity. And then you go to the efficiency and ease process there. And obviously with the ease, well, it's different now, but once we get back to a more normal mortgage world, is that interest rates are crazy now. There's a lot of stuff going on, but you can't just buy a house or refinance, within a day. Essentially, people are getting houses in 30 days. It's crazy out here. Okay. But those are the three main things: income, assets, and liquidity. So now the question is, how do you make use of your income, assets, and liquidity? Your income is going to be used to first pay for your expenses, right, on a budget, managing your wealth, but then putting you in a position to where you can increase or invest more, right, from an asset standpoint. But you also want to make sure you're liquid. So liquidity can not only be just your cash reserves, right? You can think about it like your emergency fund. And I won't get into how much should be in your emergency fund or how liquid, right, your emergency fund should be. Most people recommend it should be highly liquid. But not only do you have cash on hand that's efficient and readily or easily accessible, but also looking at your assets and how liquid your assets are. So if you want to talk about your primary residence being an asset, it's not that liquid. At the end of the day, you have to get debt to get it. You need the bank's approval. Oh no, my camera's falling. You have to get the bank's approval. You have to get the bank's approval to get the money out, and that's not guaranteed. You need somebody else to approve you for this money, versus something like your personal brokerage account or your stock portfolio, your Fidelity, your Vanguard, your Robinhood, whatever you have. That's extremely liquid. All you can usually get that money in, 3 business days top, right? So don't sell on a Friday expecting it the next day. But you can usually sell, your stock, your Apple stock, whatever your VU, whatever it is, you can sell that same day, right? And you can get that money right away. Now there's capital gains, right? Which you want there to be, right? Assets here, you want to go up, right? You want that. How do they define assets? With in the future can generate cash flow, right? Reduce expenses, right? Or improve sales, right? You do sell your stock, right? So you do plan on making money. So you are going to have those capital gains, short term or long term. Long term, if it's 366 days or more, right? Capital gains. You are going to have to pay those taxes on that, but you can get that money relatively quickly. You can get that money way faster. You can get money out of your mortgage, out of your 401k, right? And both of these things too, your 401k, your mortgage, they require you to take out debt. If you take out a 401k loan, I mean, that's debt. You do got to pay that back right away. Not right away, but you got to pay it back right away if you end up losing your job. whether you leave or get fired, things like that. So there's more risk attached to these things as well from a 401k or mortgage standpoint. And that goes back into the ease or efficiency aspect of things when it talks about liquidity. Okay, liquidity refers to the efficiency or ease with which an asset or security can be converted into ready cash, right, without affecting its market price. Okay, so you want to be able to have assets, and usually it's going to be in the form of a personal broker account, or if you have a business and you have a lot of cash reserves, which is what I talk about from a budgeting standpoint. Your income, right, the sixth thing in the financial house is your emergency fund. But for me, I don't define your emergency fund as just your 3 to 6 months of expenses or whatever you have saved. It's also about having 20% minimum left over in cash flow after you pay for your necessities and your debt payments. So you have some liquidity there to pay for things. Okay, well, a lot of people's issues is they can get out of debt, but they can't stay out of debt. And one of the reasons people can't stay out of debt once they get out of it is because not that they're not on a good budget, they don't know how to manage their finances, but they're not that liquid, or they haven't set up proper liquidity in their finances. So a lot of people, I'm working on not saying okay in between, like my little pause. So I gotta take a pause. A lot of people may make enough money to pay for their entire budget as far as what their income for the month is and what their expenses are for the month. However, they're not that liquid because when the expenses are due versus when the income comes in, they're actually almost at a deficit or close to it. They got to find a way to find some more cash pop up or become more liquid. So what I've done for myself is that's why I had the bills account, which pays for all of my bills, for the previous month. So going into was October here, right? I already have all the money in an account for all the bills that, on auto pay that come out, not groceries and things like that, but the rent, utilities, whatever. What that does is put me in the most liquid position I can be in, because now I've already taken care of all of my bills. And even though I make enough money to pay for everything, when the bills come in, I would be extremely cash strapped or not that liquid, because most of my money or my cash will be already gone because of just how it's set up when the bills are due. Most of the bills are due on the first, right? And so my first check covers everything, but after I pay for all the bills and stuff like that, it's not that much room to get like groceries and gas and things of that nature. So by having this bills account, it puts me in an extremely liquid position where essentially I pay myself back with the second check. So that I use the bills account as like my first check, right? And then since I get paid on the first, it's like I got my 2 checks on the first of the month. And so I have all the money for all of my bills, and including the groceries and things like that. We go shopping every week. So I'm able to pay for things as needed because I'm in the most liquid position I can be in. And then when we get into the assets versus liquidity, we're talking about the liabilities, no debt over here. So and on a budget, investing, right, assets. So as my income increases, it'll go straight to my assets. Now, inflation is crazy high, so some of this money increase does have to create a little bit more buffer for the general necessities like groceries and gas, because things keep going up. But in general, with me being on a budget, managing my finances, right, managing my income, because you don't manage your expenses. Your expenses are a subset of your income, meaning they come after it. We all have expenses, but you have to take your income and then give some of it to your expenses. So managing my income properly, right? Okay, expenses are taken care of, no debt, right? In an extremely liquid position relative to my financial situation. And it's like, boom, any increase in income, the income goes straight to the assets. And then if I need a buffer from a liquidity standpoint, then I add more, to the bills account to create more buffer, so I'm more liquid. So a lot of you need to be in a position where not only you're looking at, hey, I need to reduce my debt, increase my income, or increase my assets, bump up my investing, how much I'm investing a month, but you also need to look at how liquid you are. If you don't have any cash to tap into, even though you're out of debt, what you're like going to use. If you don't have any cash, right? If you don't have the money to pay for it and you can't liquidate one of your assets to pay cash for something, you have to use liabilities here. And that's what happens with a lot of people. They're able to get out of debt. And even if they have the emergency fund in place, they tap into their emergency fund, but they have no cash flow. So they take all the money out of their emergency fund. And usually 2 bad things happen at once, not one bad thing, in the sense of they tap into their emergency fund and now they need to tap into it again, but they don't have enough left because they've already used some of it and they haven't replenished their emergency fund to what it needs to be, and they haven't had the time, as far as not enough time has gone on to where they've been out of debt and investing enough, have enough assets, enough liquid assets in this sense, in a personal brokerage account where they can liquidate that stuff and compensate for any deficiency as far as their cash flow. But since they don't have enough cash, so they're not liquid enough, they end up using credit cards, right? They go back into debt, and that's what happens. They're able to get out of it, but they can't stay out of it because they haven't built that cash flow or that liquidity into their finances. I think one of these talked about cash flow. Did one of these talk about cash flow? No, I'm saying that out loud. It might have been assets. Yeah, oh yeah, assets can generate cash flow in the future. All right. So you can, think about yourself as an asset, but your income, your income, as Dave Ramsey says, is your biggest wealth building tool. Whatever your income is, that's what's going to go to the assets, the liabilities, and impact how much you have in liabilities and what you're putting towards your assets, or how your assets are set up, is going to determine your liquidity. Okay. So again, real quick for a recap, your income. My goodness, there's so many tabs to switch through. Your income refers to the money that you earn, right, in exchange for labor. So think about it like your W-2, your 1099, your entrepreneur, whatever you're getting paid, how much you're getting paid every month into your bank account. Okay, make sure you pay taxes if you're getting 1099, your entrepreneur. So after you pay your taxes, okay, don't commit tax fraud. Remember, you can do tax avoidance, not tax evasion. All right, but income is how much money you're earning. Then your liabilities is something a person owes, usually a sum of money, right, debt, loans, mortgages, all those type of things. Then assets can be contrasted with liabilities. Assets are what you own, and they can be thought of something that in the future can generate cash flow and reduce expenses or improve sales. And then the last thing is liquidity. It refers to the efficiency or ease with which an asset or security can be converted into ready cash without affecting its market price. So if you don't have a lot of cash on hand on a monthly basis, talking about making your monthly budget, your monthly income very liquid, you should work to do that. How do you do that? Well, if you have debt, that's the first way. Get rid of the debt. Okay. Remember your debt is in the liabilities category, even if it's going to an asset. And this is when it's just like, oh my goodness, this is why I just pay off the debt and don't argue about, well, it's going to my car, which I enjoy, or it's going to my student loans. It's like, get rid of the debt. Because from a budget standpoint, you cannot use that money for anything else. Those debt payments eat into your liquidity for the month. And a lot of you, once these student loan payments start back up in January of 2023, you're going to lose, a lot of the liquidity that you've been, messing around with, since the pandemic started. Okay. But first thing you need to do is work on lowering and fixing your expenses. One way to fix them is to pay off and lower them at the same time. Is to pay off your debt and not go back into debt. So get rid of your car payment, never have a car payment again. Get rid of your student loans, never take out student loans again, get rid of credit cards, etc. Right. Any debts you do have, pay it off, and make sure you never have any more minimum payments again attached to that. So that's the first thing. Then, and this is what I recommend, you look into increasing your income. Okay. You got to get your expenses on hold first. Because the last thing you want to do is be somebody out here. And by somebody means a lot of somebodies who have high incomes, right? These people in a situation where they don't qualify for the student loan forgiveness. You have high incomes, but then since you have all this debt or all these liabilities, you can't make use of your income and turn it into assets. And then so you have all these liabilities, you're not liquid at all. The last thing you want to do is have a whole bunch of income, make a whole bunch of money, but you can't keep none of it because your liabilities are so high. Okay. So that's one of the other reasons you need to work on decreasing your liabilities, fixing your expenses, getting on a budget. So when you do have the income, you're able to use it to your benefit. Right? A lot of you don't have any income. It's the bank's income. A lot of you get your direct deposit and you damn near give it all right back to the bank as soon as it hits your account in the form of debt payments. Okay. And then once you're able to get rid of your debt and get on your budget and fix your expenses, that's when it's straight up. You just look and say, okay, that's talking about the 401k match, maxing out the Roth IRA, those initial 2 steps that most people need to take. And then it's like, okay, once you're doing that, and especially with the Roth IRA, since that's post-tax money that you're contributing, again, that's impacting, right, your liquidity. That's something you actually have to do. You want to sit down and say, how good am a position am I in from a liquidity standpoint? You're building your assets, you got your 401k contribution, your match, and you're maxing out your Roth IRA for the year. And then you think, okay, how can I increase your income? How can you increase your income to invest more inside of assets? And then what do you need to do as far as your budget, on your personal budget, to make yourself a little bit more liquid as far as setting up a bills account, things of that nature. And then look at, I'm doing the 401k, doing the Roth, that's tax deferred. As far as the 401k, and you're paying taxes up front as far as the Roth, but those aren't that liquid. The Roth's a little bit more liquid than your 401k because you can't take any money out that you contribute as long as it's not part of the gains. But you do have to worry about paying penalties if you do take out some of your gains. But that's when you look into the personal brokerage account in this example from a liquidity standpoint and say, okay, I got money growing from an asset standpoint in the stock market, but it's in my personal brokerage account, so I'm extremely liquid. All I got to do is worry about paying the long-term capital gains on it, right? Short-term capital gains for you selling stuff, you people selling stuff under a year. But long-term capital gains for most of you is 15%, which is going to be lower than your tax bracket. Okay, the tax brackets are 10, 12, and 22. So most people are in that 22% range. Well, that 12 or 22%, depending if you're married or single. But a lot of you, what the short-term capital gains, or the long-term capital gains is, it's going to be less than what you make on your W-2. So as that asset, right, something in the future that can generate cash flow, reduce expenses, or improve sales, something that can make you money in the future, your stock portfolio, right, when you liquidate those stocks, right, that portfolio, you're going to be paying less taxes than you would on your W-2 money. All right. So those are the things you need to look at from an income, assets, and liability standpoint. You got to get on a budget and pay off the debt. That if you do, it's hard to make use of your income from an assets and liquidity standpoint if you're not on a budget and you have a whole bunch of debt. There's not much you can do, as I mentioned before. I've already said this before. If you have a lot of debt, right, that's income ratio, that type of thing, it's not much you can do, out earn it, because it's likely if you have a lot of debt, then you haven't been properly managing your finances, and a lot of debt by your standards. And let's not say a lot of debt by my standards, but if you have too much debt by your standards, then clearly you have too much debt, and you need to find a way to at least put yourself, define how you want to handle that way. Put yourself in a position where you have how much debt you want to have. Okay. And then once you're in that situation, right, you look at obviously increasing your income and your assets and liabilities. All right. So that's income versus assets, liabilities conversation. As always, you have any questions, concerns, please DM me, YouTube comments, Instagram comments, whatever it is. Again, as I said, I am sideline_Cory. You can find me on Twitter, Instagram, and TikTok. My co-host Jordan is Stop Stalling J on Twitter, Instagram, and TikTok as well. And his business page is FinallyFit.live. All right. Make sure y'all hit that like button on your way out. If you didn't hit on the way in, hit it on the way out. If you're listening to this, please leave them rating reviews on the podcast platforms as well. Leave the comments on the YouTube video as well. All right, y'all. That's it for this one. These Wealth Wednesdays are getting fun. I think next week, I don't know when I'm gonna do the student loan recap, because the information I'm trying to do one last student loan thing, because it's not like I do little small clips. I'm trying to wait till a little bit more information comes out, so I don't have to keep doing updates on these. But so I'll do a current event episode once some more official student loan information drops. Y'all do have by December 31st, if I didn't say that, of this year to apply for it. So make sure once it goes up, I think it's studentaid.gov, and you got to subscribe for the student loan email alerts, so they let you know when that application is up. But yeah, they're giving y'all three months. It's probably going to drop October 4th, because that's the first business day. October 3rd. Yeah, September 30th is on a Friday, I think, this year. Yeah, so it's probably going to drop October 3rd at the earliest, my guess is. I doubt they'll put it up on a Saturday or Sunday. So the first business day in October is Monday the 3rd. That's when it'll probably drop. So that's why y'all need to be paying attention to your emails about it. Hopefully they let y'all know when it's going to drop before it drops, instead of saying like it's like when artists do a release at midnight and my album's out. All right, but that's it, y'all. So again, make sure you hit that like button and make sure you leave us those rating reviews. But as always, remember to save more, say less, and keep making better your best. And I will catch y'all in the next one.